Hey everyone, and welcome back to the channel. Today, we're diving deep into a company that's literally building the future of global trade, Yangzijiang Shipbuilding. You might not have heard of them, but this Chinese shipbuilding giant is making waves, and we're going to break down their recent performance, what's driving their growth, and the potential risks on the horizon. Stick around because this is a fascinating story of a company navigating complex global waters. If you haven't already subscribed to our channel, please subscribe to our channel. Your support truly makes a difference, enabling us to produce more stock and fundamental analysis content. But first, a quick disclaimer. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. Who exactly is Yangzijiang Shipbuilding? Well, they're one of China's largest privately owned shipbuilders, founded all the way back in 1956. While their main game is, you guessed it, building ships, everything from massive container ships to oil tankers and even advanced LNG carriers. They're not just a one-trick pony. They also have a shipping arm that earns revenue from chartering out vessels and an other segment that includes things like terminal services and property investments. This diversified approach is actually a smart move, giving them more stability than a pure play shipbuilder, especially in an industry that can be quite cyclical. It means they have multiple ways to make money, which is always a good sign. Now let's talk numbers, and trust me, they're impressive. Yangzijiang Shipbuilding had a fantastic 2024, reporting what they called record profits. Their revenue jumped by over 10% to 26.5 billion renminbi, and their net profit soared by a massive 77.2% in the first half of 2023 alone. For the full year 2024, their net income hit SGD 1.24 billion. But it's not just about big numbers, it's about how efficiently they're making that money. Their profit margins, that's how much profit they keep from every dollar of sales, are significantly higher than the industry average. For example, their net profit margin is nearly 25% compared to the industry average of just over 7%. This tells us they're incredibly good at managing costs and getting high-value contracts. And looking at the first quarter of 2025, they've already delivered 21 vessels, hitting 38% of their target of 56 vessels for the entire year. So, strong performance, efficient operations, that's the picture so far. So, how healthy is this company financially? In short, very healthy. Yangzijiang Shipbuilding has a rock-solid balance sheet. They're sitting on a huge pile of cash and cash equivalents, over SGD 5.3 billion to be exact. And get this, when you compare that to their total debt of SGD 1.27 billion, they have a net cash position of over SGD 4 billion. That's like having way more money in your bank account than you owe on your credit cards. Their liquidity ratios are strong, meaning they have plenty of cash to cover their short-term bills, and their debt-to-equity ratio is incredibly low, just 0.26, which is far below the industry average. This means they're not relying heavily on borrowed money, giving them a lot of financial flexibility. Plus, they're excellent at turning their assets into profits. Their return on equity is nearly 28%, which is more than double the industry average. All these indicators point to a financially robust company that's managing its money exceptionally well. What's going to keep this shipbuilding giant growing? There are a few key engines driving their future. First, they have an absolutely massive outstanding order book. We are talking $23.2 billion as of May 2025. That's a huge backlog of confirmed work that guarantees revenue for years to come. Second, they're making smart strategic investments. They're building Project Hongyuan, a massive green high-tech shipbuilding base set to finish by late 2026. They're also constructing an LNG terminal business expected to be ready by mid-2027. These aren't just random projects, they're directly aligned with the biggest trends in the global shipping industry. And that brings us to the global market trends themselves. The shipbuilding market is growing, projected to reach over $200 billion by 2030. Why? Government support. Many governments are investing heavily in their maritime sectors. Global trade, more goods moving around the world means more demand for ships. And crucially, green shipping, there's a massive push for environmentally friendly vessels. Regulations are getting stricter, and clients want ships that run on cleaner fuels like LNG, ammonia, or hydrogen and have more efficient designs. Yangzijiang's investments in green tech put them right at the forefront of this transformation. Now, it's not all smooth sailing. Every company faces headwinds, and Yangzijiang is no exception. One of the biggest concerns is geopolitical tensions, specifically the ongoing US-China trade policies. The US has been investigating China's shipbuilding dominance, and there are proposals for new fees or tariffs on Chinese-built vessels entering US ports. This has already made some customers hesitant, leading to a wait-and-see approach and slowing down new orders in early 2025. While the full impact is still uncertain, it could mean higher costs for cargo owners and potentially shift trade routes. Another challenge is raw material price fluctuations, especially for steel, which is a core component of shipbuilding. While steel prices have been low, there's always a risk of volatility. To counter this, shipyards can use strategies like long-term contracts with suppliers, diversifying their supplier base, and even using financial hedging tools. Finally, the competitive landscape is intense. China already dominates global shipbuilding, accounting for over 50% of the market. This dominance is partly due to state support and subsidies for Chinese firms, which can create an uneven playing field for privately owned companies like Yangzijiang. Despite these challenges, the future outlook for Yangzijiang Shipbuilding looks quite positive. Analysts are very bullish, with a strong buy consensus from 9 analysts polled over the last 3 months. The average 12-month price target suggests a potential upside of nearly 36% from current levels. Their earnings are forecast to grow by almost 13% per year, and revenue by over 15% annually, outpacing the broader Singapore market. So, what's driving the high trading volume we've seen recently? It's a combination of factors. Share buybacks. The company has been actively repurchasing its own shares, signaling management's confidence and potentially boosting earnings per share. Dividend payouts. Consistent dividends and positive news about them also attract investors. Analyst upgrades, positive ratings, and price target increases from analysts also generate excitement and trading activity. These corporate actions show a commitment to shareholder returns and reinforce investor confidence, leading to increased interest in trading. So to wrap it all up, Yangzijiang Shipbuilding is a financially strong company with impressive recent performance and a clear path for future growth, especially in the booming green shipping sector. They are well positioned to capitalize on global trade and decarbonization trends. However, investors need to keep a close eye on geopolitical developments, particularly US-China trade relations and how they might affect future orders. Raw material costs are also a factor to monitor. Overall, with a strong order book, strategic investments, and positive analyst sentiment, Yangzijiang Shipbuilding appears to be a compelling company in a critical global industry. What do you think about Yangzijiang Shipbuilding? Let us know in the comments below. Don't forget to like this video, subscribe for more in-depth analyses, and hit that notification bell so you don't miss our next deep dive. Thanks for watching, and we'll see you next time.